Hello and welcome to a new video on the Easy Finance channel. Have you ever wondered why companies report expenses and revenues even when no cash has exchanged hands yet? That's where accruals and deferrals come into play. These concepts are important for accurate financial reporting. In this video, we will break down what accruals and deferrals are, why they matter, and how they affect financial statements, all in simple terms. But first, a quick refresher. In cash accounting, transactions are recorded only when cash change hands. For example, you recognize revenue when you receive money and expenses when you pay bills. In contrast, accrual basis accounting recognizes revenues and expenses when they are earned or incurred, regardless of when cash is paid or received. This gives a more accurate picture of a company's financial health. Accruals and deferrals are simply tools to make this happen. So, let's start with the definition of both. Accrual. An accrual is a transaction in which the revenue has been earned or the expense has been incurred, but no cash has been exchanged. On the other side, deferrals. A deferral is a transaction in which the cash is exchanged before the revenue has been earned or the expense has been incurred. A simple rule to memorize it better is for accruals, action before dollars. Both starts with an A. For deferrals, it is dollars before action, so both start with a D. For both accruals or deferrals, we can have revenue and expenses. I will explain you both. So let's start with accrued revenue. Imagine you mow your neighbor's lawn in May and agree they will pay you in June. Even though you don't get the cash until June, you have already earned that money in May. Businesses work the same way. If a company delivers a product or service, it records the revenue right away, even if the cash comes later. Accrued expenses on the other side. Now think about your electricity bill. You use electricity all December, but the bill only arrives in January. You already owe the money for December usage, so that expense belongs in December, not January. That is exactly what companies do with accrued expenses, like salaries, interest, or utilities. It is for the last month, but they paid in the next months. So, what are deferrals? Deferrals are the opposite. Remember what I told you. Dollar before action. The cash is paid or received first, but the expense or revenue is recognized later. I will also give you here a quick example to understand it better. Deferred revenues, also called unearned revenues. Let's say you buy a Netflix subscription for the entire year and pay upfront in January. Netflix can't recognize all that money as revenue in January because you are paying for 12 months. Instead, they defer the revenue and record part of it each month. If you paid $120 for the entire year, they will recognize every month a revenue of $10. Deferred expenses, or also called prepaid expenses, it is basically the same as the situation before, only out of the other perspective. The revenue is out of Netflix perspective, but of your perspective, it is a prepaid expense. You paid for it in advance and collect the service or the goods later for the entire year. The same is it for companies with prepaid insurance or prepaid rent. They pay upfront for 1 year and then they record it as an asset and expense it little by little as the benefit is used. Why are accruals and deferrals so important? Accruals and deferrals ensure that revenue and expenses are recorded in the correct accounting period, aligning with the matching principle. This principle states that expenses should be recorded in the same period as the revenues they help generate. You can find also an extra video in the description about this and other accounting principles. Without these adjustments, financial statements could be misleading. A company might appear more profitable or less profitable simply because cash hasn't moved yet, which can completely distort the true picture of performance. Now we dive in a quick example of journal entries. If a company earns $5,000 in consulting services in December but invoices a client in January, it records debit, accounts receivable, $5,000, and credit revenue with $5,000. The $5,000 debit on the accounts receivable here is an asset, because the money is not collected yet. So the revenue is already booked, but the cash has not arrived yet. If the client is then paying the money, the company will credit the accounts receivable. So you have on the debit and on the credit side 5,000 in accounts receivable, and you will debit cash or bank with 5,000. Another example is prepaid insurance. Prepaid insurance is, in our example, $1,200 per year. The entry in January is you debit the prepaid insurance, this is an asset, and you credit cash with $1,200. Then each month $100 is expensed and so deducted from the asset. Every month we have the entry debit insurance expense of $100 and credit the prepaid insurance of $100. This way, expenses and revenues are matched to the period they belong. And that's accruals and deferrals. The amount signed and that's accruals and deferrals. The amount signed and that's accruals and deferrals. They might sound like small accounting adjustments, but they play an important role in ensuring a true picture of the financial statements and prevent fraud. If you found this video helpful, give it a thumbs up, subscribe to the channel for more finance and accounting related topics, and I will see you in the next video. Bye bye!